Hey everybody, so I know I said I was going to quit YouTube, but I found out shortly thereafter that I'm kind of an addict. So I am admitting that I'm definitely an addict when it comes to making YouTube videos. I've been making YouTube videos for like the last year and well over 200 videos. So, it feels a little bit off when I have something to say, but I'm not necessarily making a video. So now I'm backtracking, and here's exactly what I want to talk about. So I want to talk about the Fed Funds Futures and how you can read into this by going into TradingView and then looking this up. So I want to just talk about futures in general. So when we're talking about futures, we have a ticker symbol, and then we have a month, and then we have a year. So ZQ, if I just type in ZQ right here, that represents the Fed Funds Futures. Now, if I type in something like H will represent March. If I type in something like Z will represent December. And then after this, I want to type in the year. So I could do 2023 for this year right now. So let me just show you a little bit more of that. So right now I'm on MarketWiki, and this is basically showing you all the symbols for the Fed Funds Futures, or just futures in general. So you'll put in the ticker symbol followed by an F, a G, H, J, K, or all the way down to Z. And this is basically saying, hey, this is the futures contract for January. Or hey, that's the futures contract for February. Or hey, Z is the futures contract for December. So that's basically how the structure works. So if I wanted to look at Fed Funds Futures for March, which is the most recent one that we're going to get here in a month or so. So I'm just going to type in ZQH 2023. And going back here, you can see H represents March. So how does the Fed Funds Futures actually work? So it's a little bit tricky. So if you're looking at this number right here, 95.34. So if you're looking at that, you're basically basing this number off of 100. So if 100 represents 0, then anything below 100 is representing our current rate structure. So what we do is 100 minus 95.34. So that's representing something along the lines of 4.75-ish is very close to where it's at. So 4.5 to 4.75-ish. So that's essentially what it's looking at. But you have to remember that the Fed funds rate is almost like a target. It's not necessarily this or that. They say, hey, right now the Fed's funds rate is 4.5 to 4.75 or 4.75 to 5. So it's always this target range. So right now we're actually sitting at 4.5 to 4.75. So a better way to actually understand how to properly use this is to use a spread. So what I can do is I can look at ZQH 2023, or I could look at ZQZ 2023, or I could look at the difference between both of them. So let's go ahead and look at ZQZ 2023. So this is going to represent the December contract. So notice that it's 95.11. So if we were to subtract 100 from 95.11, it's very close to 5%-ish. So yeah, it's around that 5%-ish area. So notice that if this number is lower, it's essentially forecasting more rate hikes or a higher Fed funds rate. So lower means bad, essentially, because we're going to go enter into a more restrictive monetary policy. So here's the best way to utilize this. So I'm going to look at the March contracts, and then I'm going to look at the December contracts. So I'm going to do ZQH 2023 minus ZQZ 2023. Now, this is kind of going to mess with your psychology a little bit, because you would think, hey, wouldn't I subtract the December contract from the March? No, you're actually doing the March from the December, because you have to remember that the Fed funds rate is working backwards. So it's looking at what's the difference between 100 and where we are now, which is basically the expected Fed funds rate for that contract. So now we're going to go ahead and we're going to enter this. Now, here's a very concerning thing that I'm seeing. So right here, we were at about negative 0.2. This was pretty much last week when we got the jobs report. So before the jobs report, we were actually expecting the Fed funds rate to be 25 points lower in December versus the March Fed funds rate. So think about where we are at right now. We're at 4.5 to 4.75. So essentially, we're expecting another 25 basis point hike in March, along with the summary of economic projections. So that is essentially going to put us at 4.75 to 5 for March for the Fed funds rate. So what this right here is saying was that before the jobs data came out, we were expecting a 25-point cut. So we were actually expecting the Fed funds rate to be at around 4.5 to 4.75 because it's 25 points lower than what the March contract was expected to be. Now we're expecting the December contract to be 25 points higher than the March contract. So if we're expecting the Fed funds rate to be at around 4.75 to 5, well, that's not the same anymore. Now we're expecting it to be 5 to 5.25. So that is essentially what happened right here. So, things are a little bit more riskier, but this is the mind-boggling thing. At the same time this happened, you saw stocks literally plummet, but then they rallied even harder. So right now, the Fed Funds Futures are telling us, hey, we're not going to see those rate cuts. We're going to see 5 to 5.25, and we're going to see that being held there. That's not necessarily a good situation for the markets. And we saw the dollar rebounding as well. Let me go over and look at the dollar here. So let's look at DXY. So this is the dollar index. Now I have a lot of different lines here. So this orange line is basically representing every single time we had this interest rate hike. So you can see price action gets really wonky. So right here, we had this falling wedge. We broke out, we back tested, but we're still underneath this longer term support here, as you guys can see. So this is now acting as resistance. But do note, we have this little box that we broke out of. So let me go on to a shorter time frame here. So you guys can see that, we're kind of messing around, but we're still managing to stay above this box. So obviously, if the dollar rockets back up, that's not going to be a good situation for these multinationals. If these multinationals are already, if they're already facing pressure from revenues declining, what's going to happen if you add currency headwinds on top of that? That's further deceleration of revenue. And if you also see demand destruction, further deceleration of revenue. If you see inflation going into deflation, that is further destruction of revenue. So revenue can go down in many, many ways here. And this is very, very risky. So you have to remember that in 2022, we saw very high inflation. Now, revenue is not adjusted for inflation. So going into 2023, if we start seeing deflation and we start seeing a stronger dollar and we start seeing all of this nonsense, that could really, really hurt revenues. So something to be very, very wary of. Now, there is something else that I'm looking at. I'm looking at the VIX. And the VIX hasn't done anything for quite a while. It's done a whole lot of nothing. So if we're looking at the VIX, let me just go on this 1-year chart. I want to zoom out. Now, notice right here, this was basically when we saw that crash and we saw this massive gap being formed. So what we recently just came back to visit is this solid line right here that is basically showing the beginning of this gap formation. We pretty much went all the way back down to this area. We slightly cut underneath it and then we rallied. So if you notice right now, we're kind of in this falling wedge pattern, but right now we're literally at the top, and we've hit this top several times. So several times. We thought we were going to break out here, but we didn't. Thought we were going to break out here, but we didn't. And it could be the same situation right here as well. We could be breaking out here, and then maybe we don't, and then we just reject. So let's just look at this right here. So if we're looking at this closer, it's fighting for it. It's fighting for it. It could honestly just drop right back down, but it's fighting for it right now. Let's go ahead and look at SPY. Now my SPY chart is very messy. It's pretty darn messy. But you can basically see what I'm looking at right here. So let's see. Alrighty. So if I'm looking at these blue lines are basically representing quarters. These yellow lines are representing the Fed meetings. So if we're looking right now, we're in this channel. And let me go on a lower time frame. So if we're looking at this channel right now, we are literally fighting tooth and nail to hold it. So honestly, we could just rally right back and have this massive roaring rally that makes zero sense whatsoever. And you could see pretty much everybody saying, hey, you know what? Soft landing, everything's fine. Don't worry about a thing. Jerome Powell's got our back. Buy Bed Bath & Beyond, do all of this stupid crazy stuff. And you could see that. I mean, I'm totally saying that you could see that right here. I mean, we need to see this seriously break down to then see some sort of narrative that we're a little bit more bearish, or there is a little bit more risk to the market going up like this. Now you have to remember that sometimes the market can move off these things like interest rates and all of that. But if we're looking at the underlying fundamentals behind a lot of these companies that are in these indices, what we're seeing is revenue decline. What we're seeing is earnings per share decline. So, let's just go back. Let's zoom out a little bit. If we're looking at this resistance line, notice that it's down sloping. So if we were to break back into this, it could be a lot lower, especially if we take time. So if we were to take our time, chop around sideways, and then break back into this, it could be at a much lower price because this is down sloping. Now I do want to show you one last thing before I do get off here. I want to look at Google. Now to me, Google's a little bit concerning. So obviously there's some information out about their AI, which is Bard or whatever. But anywho, look at this chart formation. So I'm just going to go ahead and delete this just because that's extra noise. So here's what I'm looking at. I'm looking at this downtrend line. We saw this breakout, and now we're right back into this wedge. So is it possible, if we're seeing this with Google, is it possible that you could see this with other stocks? The other mega caps, are they going to start attacking these individual names while trying to balance everything else, making the market look like it's fine? So that's essentially what I'm looking at right now. And as far as my outlook, I'm definitely leaning a lot more bearish than I am bullish. Just thinking about what I think the market is worth, and just looking at the major stocks that make up S&P 500 and NASDAQ, I just think that the valuations are a little bit lofty here, especially if we're considering, that rates are about to top off. You could really see a lot of people starting to chase bonds and selling off some stocks. So I think that's a very possible scenario. And you do have to remember that a lot of these zombie companies, they could easily go bankrupt. So you could see a series of bankruptcies just because, in this period of time where we saw rates go up, a lot of these companies, they saw their credit ratings go down, and, they started basically doing all sorts of secondary offerings. Now their stock prices are so freaking low that they can't really do these stock offerings that much anymore. And you have to wonder, well, how are they going to get their financing? And if they are going to issue more debt, they have to do this at a much higher rate. So it gets very, very risky for a lot of these zombie companies that do not have the financing. So that being said, that's all I wanted to say, and hope you guys enjoyed this video.